What's up guys, and welcome to WSM Research. On this channel, we cover high growth stocks that we think growth or value oriented investors should have their eye on. Today we're going to talk about a beaten down growth stock that is seeing increasing sales at the same time as it has been hit particularly hard by the tech sell-off of the early part of this year. While the broader market has rebounded from the sell-off from January and February, there is a distinct slice of mainly technology names that have yet to recover. This has especially afflicted some of the so-called hope stocks, or the high-flying growth stocks with substantial parts of their valuations based on earnings several years into the future. This comes as inflation worries are making headlines on an almost daily basis right around now. Along with inflation worries comes the possibility of the Fed finally deciding to throw in the towel and raise rates. If these things happen on a large scale over the next few months and years, that would erode the present value of future earnings of companies. That is the reason why some tech companies with little to no current earnings have been hit the hardest. However, that also means that some stocks that are obvious longs have also been hit. In this video, we're going to take a deep dive into one particular casualty of this sell-off which seems to have been unfairly beaten down, and that is Wish. Before we go any further, please note that we are not financial advisors and this video is for entertainment purposes only. Make sure to do your own research and consult with a licensed professional before making any investment decision. Wish is primarily an e-commerce platform that focuses on discount items transacting between buyers and sellers. It has everything from designer clothing, camping supplies, electronic devices, and anything else you could think of. They have over 1 million merchants selling on their platform. It might remind you a lot of eBay, and the basic idea behind Wish is very similar to eBay. However, it is distinct from eBay in the experience that it offers consumers. Whereas eBay is used to find deals on cheaper items or equally to find more niche items, on the other hand, Wish is primarily a mobile-based platform and targets younger people. It also specifically aims at households with $75,000 a year of income or less, and importantly, targets experiential shopping. In other words, it is a way for people to have fun shopping for things that they don't really set out looking for beforehand. You've probably seen Wish's marketing, whether it be from their sponsorship of NBA teams or direct advertising. As a result of these marketing efforts and their enjoyable platform, they have experienced incredible growth in the past several years. We'll take a closer look at 3 points to make a final conclusion about the stock. The first is how fast it's growing revenues. The second is what the market's concerns are about the company and whether they are something that investors should be worrying about. The third is the valuation of the company and how they might look 3 to 5 years from now. On May 12th, Wish reported their first quarter earnings, which they described as stronger than expected. The main highlights were that revenue growth grew 75% year over year, which was an acceleration over the previous year's growth. Equally importantly, their revenue per active buyer also increased by 76% over the prior year. This continues a history of strong growth in recent years, from $1.1 billion of revenue in 2017 to about $3 billion a year today. That's a tripling in revenue in only 3 years. To put that into perspective, that's about the same growth rate in revenue that Tesla has experienced over the past 3 years. Another supposedly high growth name, Facebook, has only grown revenue by a factor of 2 since 2017. So Wish can compete with the very best of tech in terms of its raw revenue growth. But there's also reason to believe that Wish's growth is perhaps more sustainable and has more runway for growth in the near term. Wish mainly targets households with middle to lower incomes and offers products that can be seen as fun shopping items. One of the effects of the pandemic is that some people have found themselves with less stable incomes or job prospects than before, and would therefore be more likely to shop with Wish than other higher-priced alternatives. For these reasons and others, Wish's own guidance for the next quarter is again for high revenue growth. They expect revenue to grow to $730 million, which is not that much more than the $715 million they made in the previous year, but last year's second quarter results were extremely good. In that period, sales grew 67% because of the pandemic. So by them forecasting some growth even with these tough comparisons is actually confirmation that management believes secular growth to continue. Furthermore, the industry that they are in is enormous and growing fast. E-commerce was a $3.4 trillion industry in 2019 and expected to grow to $6.3 trillion by 2024. Wish plays in the 63% of e-commerce that is mobile-based, and mobile-based e-commerce is expected to take 75% of total e-commerce by 2024. Wish only makes up a very small $3 billion portion of the industry today, which is less than 1/10 of 1%, meaning that there is basically unlimited room to grow. Meanwhile, the growing industry will be a tailwind for Wish's sales. So Wish is definitely in the right industry for continued revenue growth into the future. There are some concerns about the quality of the revenue growth for Wish, however. Their revenue has only come at the high cost of aggressive marketing. In the last quarter, they spent two-thirds of their revenue on marketing, or $470 million. This caused a $126 million net loss for the quarter. Even more alarmingly, this loss was almost double the loss from the first quarter in 2020. That is a big reason why their stock tanked by 30% on earnings. But it's really not nearly as bad as it seems. No matter how you look at it, their marketing has been working. You can't get industry-leading user and revenue growth without spending on marketing. Plus, marketing expenses can be cut at any time. Besides marketing, Wish had very little other costs, only about $93 million of product development and administrative costs. That left $680 million of revenue left over in the last quarter for marketing, but it didn't have to be spent on marketing. It could have been realized as earnings, in which case that would have implied a price-to-earnings multiple of about 2. And that brings us to valuations. Wish is still making a net loss, so price-to-earnings valuation metrics don't really tell us much. But on a price-to-sales basis, after the brutal pullback of the last several months, Wish is now trading at $6.3 billion of market cap on sales of $3 billion a year. That gives it an incredibly cheap price-to-sales multiple of 2. But it doesn't even end there. They also have nearly $2 billion of cash-like assets on the balance sheet, compared to only about $1 billion of liabilities. So the company actually has a tangible book value of about $1 billion for an enterprise value of closer to $5 billion. That means that if you were to buy the entire company, you would only need about $5 billion to do it instead of the $6 billion market cap, because when you buy the company, you also get the $1 billion of net tangible assets. So the price of the actual business assigned by the market is currently about $5 billion. Revenues of $3 billion on an enterprise value of $5 billion is incredibly cheap. A company's fundamental value ultimately comes down to what is the present value of all the cash flows it will make in the future. With Wish, if it continues even a fraction of its current growth and is able to eventually cut down on marketing expenses, it could make an insane amount of cash flows in the future. The question is really how long will investors have to wait before that happens? While investors wait, inflation will be taking its toll on the real value of money. This May, the annual inflation rate reached 5%, which is significantly higher than what we've seen in many years. The last time the monthly inflation rate was this high was in August of 2008, at the height of the Great Recession. If inflation stays at 5% and Wish doesn't start making actual profits for the next 5 years, then best case scenario, the value of those profits will be about 27% less than their nominal amount in terms of actual buying power. That could explain why Wish's stock has been going down at the same time as inflation has been going up. On the other hand, Wish may also see some amount of benefit from inflation if it means that they can raise prices. Given their dominant position in discount e-commerce due to all their marketing, they probably have significant pricing power in terms of the fees that they can charge their merchants. So while inflation does pose some risks to the value of Wish's future earnings, it may or may not end up being as bad as feared. The bottom line is that Wish seems to be insanely undervalued on account of its incredibly fast growth and very good gross profit margins. They are in a growing industry and have built a brand around their aggressive marketing. They are not laden with debt and could easily improve their earnings if they decide to cut back on marketing. Who knows, maybe a private equity firm will see this and realize that they can take this company private, cut marketing, and just have a cash cow spitting off $2 billion of cash a year for a price net of Wish's balance sheet of only about $5 billion. This could be another way that Wish investors could make money. Even if that doesn't happen, while inflation and interest rates are something to keep an eye on, as long as they don't get too bad, Wish seems like the type of stock whose price has gotten too detached from reality. Alright, that wraps it up for this video. If you like the content, make sure to like, subscribe, and share. Also, let us know what you think about Wish in the comment section down below. In the meantime, thank you so much for watching, and we'll see you in the next video. WSM Research, signing out.